Question 1. Quality control measures reveal that the new sales automation system, designed to streamline customer interactions and expedite policy issuance, is generating disclosures that, while technically accurate, may be overly complex for the average consumer to fully comprehend, and the system's data collection protocols are not explicitly detailing how customer information will be shared with third-party marketing partners. Which of the following approaches best addresses these findings while adhering to insurance administration regulations? Option A. Immediately halt the use of the sales automation system and revert to manual processes until all disclosure language can be simplified and data sharing practices are made fully transparent and compliant with privacy regulations. Option B. Update the automated disclosure templates with simpler language and implement a mandatory opt-in mechanism for all third-party data sharing, ensuring all changes are reviewed by legal and compliance departments before redeploying the system. Option C. Implement a supplementary email communication to customers after policy issuance, providing a simplified explanation of disclosures and a link to a detailed privacy policy, while continuing to use the current data sharing protocols. Option D. Continue using the sales automation system as is, assuming that the technical accuracy of disclosures is sufficient and that customers will seek clarification if needed, while also relying on existing general privacy policies for data sharing. Correct answer is A. Immediately halt the use of the sales automation system and revert to manual processes until all disclosure language can be simplified and data sharing practices are made fully transparent and compliant with privacy regulations. Explanation. This scenario presents a professional challenge because the implementation of sales automation tools, while intended to enhance efficiency and customer experience, can inadvertently lead to regulatory noncompliance and ethical breaches if not carefully managed. The core difficulty lies in balancing the speed and data-driven insights offered by automation with the fundamental requirements of accurate disclosure, fair treatment of consumers, and data privacy, all within the specific regulatory framework governing insurance administration. Professionals must exercise careful judgment to ensure that automated processes do not bypass or undermine these critical obligations. The correct approach involves a multifaceted strategy that prioritizes regulatory adherence and ethical conduct throughout the sales automation lifecycle. This includes rigorous testing of automated scripts and disclosures to ensure they are clear, accurate, and compliant with all applicable regulations regarding product information, pricing, and policy terms. It also necessitates robust data governance and security protocols to protect sensitive customer information, aligning with privacy laws. Furthermore, it requires ongoing training for staff who oversee or interact with these automated systems, ensuring they understand the regulatory implications and can intervene appropriately. This approach is correct because it proactively embeds compliance and ethical considerations into the design and operation of sales automation, thereby minimizing risks and fostering trust. It directly addresses the regulatory requirement for insurers to provide accurate and understandable information to consumers and to protect their data. An incorrect approach that relies solely on the efficiency gains of automation without adequate oversight fails to meet regulatory standards. For instance, deploying automated sales scripts that do not undergo thorough review for clarity and completeness could lead to misrepresentations, violating regulations that mandate clear and accurate product disclosures. Similarly, a focus on rapid data collection through automation without implementing robust data privacy measures and obtaining necessary consents would contravene data protection laws, exposing the company to significant penalties and reputational damage. Another flawed approach might involve using automated systems to push sales without providing adequate opportunities for consumers to ask questions or receive personalized advice, potentially leading to the sale of unsuitable products and violating principles of fair dealing and consumer protection. Professionals should adopt a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape. Before implementing any sales automation, they must conduct a comprehensive risk assessment, identifying potential areas of noncompliance. This should be followed by a design phase where compliance and ethical considerations are integrated from the outset. Continuous monitoring and auditing of automated processes are essential to detect and rectify any deviations from regulatory requirements or ethical standards. Finally, a culture of accountability should be fostered, where individuals are empowered to raise concerns and where the organization prioritizes ethical conduct and regulatory adherence over short-term efficiency gains. Question 2. Cost-benefit analysis shows that implementing a new, integrated policy administration system could significantly reduce operational expenses by automating manual tasks and streamlining workflows across underwriting, policy issuance, and claims processing. However, the proposed system upgrade involves decommissioning several legacy components that currently manage specific aspects of policyholder communication and premium collection, which approach best balances cost optimization with regulatory compliance and ethical policyholder treatment. Option A. Implement the new system with a phased migration of data and functionalities from legacy systems, ensuring all policyholder communication and premium collection processes are fully integrated and compliant with current regulations before decommissioning old components. Option B. Focus on automating only the underwriting and policy issuance functions within the new system, leaving legacy systems in place for premium collection and policyholder communication to avoid disrupting existing processes. Option C. Prioritize the immediate decommissioning of all legacy system components to realize the full cost savings from the new system as quickly as possible, relying on the new system's basic functionalities for all policyholder interactions. Option D. Outsource the management of policyholder communication and premium collection to a third-party vendor that offers specialized services, allowing the new system to focus on core policy administration tasks. The correct answer is A. Implement the new system with a phased migration of data and functionalities from legacy systems, ensuring all policyholder communication and premium collection processes are fully integrated and compliant with current regulations before decommissioning old components. Explanation: this scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency and cost reduction with the imperative to maintain regulatory compliance and uphold customer trust. The core tension lies in implementing process changes that, while potentially beneficial financially, must not compromise the integrity of policy administration or violate established legal and ethical standards. Careful judgment is required to ensure that any optimization efforts are sustainable and do not inadvertently create new risks or disadvantages for policyholders or the company. The correct approach involves a thorough review of existing policy administration system workflows to identify redundancies and inefficiencies, followed by the implementation of targeted automation and system enhancements. This approach is professionally sound because it directly addresses the identified cost drivers while ensuring that critical policy functions, such as premium processing, claims handling, and policyholder communication, remain accurate, timely, and compliant with all applicable regulations. Specifically, in the context of the LOMA 302, exams focus on the policy lifecycle. This means ensuring that system changes do not negatively impact the accurate recording of policy details, the timely issuance of policy documents, or the efficient processing of endorsements and surrenders, all of which are subject to regulatory oversight. This proactive and integrated approach minimizes the risk of regulatory breaches and maintains the company's reputation for reliable service. An incorrect approach that focuses solely on reducing manual data entry without a comprehensive system integration plan would be professionally unacceptable. This failure stems from a lack of understanding of how different parts of the policy administration system interact. Such an approach could lead to data silos, inconsistencies, and errors, potentially violating regulations that mandate accurate record-keeping and timely communication with policyholders. For example, if automated data entry for new policies bypasses essential validation checks, it could result in incorrect policy terms being recorded, leading to future disputes and regulatory scrutiny. Another incorrect approach that prioritizes the immediate elimination of legacy system components without a phased migration strategy would also be professionally unsound. This is because legacy systems, despite their inefficiencies, often contain critical historical data and established workflows that are essential for ongoing policy administration and regulatory reporting. Abruptly decommissioning these systems without proper data migration and system integration could lead to significant operational disruptions, loss of historical data, and non-compliance with data retention requirements. This could result in penalties and a loss of policyholder confidence. A third incorrect approach that involves outsourcing policy administration functions to a third-party vendor without conducting thorough due diligence on their compliance framework and data security protocols would be a significant ethical and regulatory failure. While outsourcing can offer cost benefits, the responsibility for regulatory compliance ultimately rests with the insurer. Failure to ensure the vendor adheres to the same stringent standards as the insurer could lead to breaches of privacy laws, data protection regulations, and other consumer protection statutes, exposing the insurer to substantial legal and reputational damage. The professional decision-making process for similar situations should involve a systematic evaluation of proposed changes. This includes 1. Identifying the specific business objectives, e.g., cost reduction, efficiency gains. 2. Assessing the potential impact on all stages of the policy lifecycle, from underwriting to claims and servicing. 3. Evaluating the proposed solutions against regulatory requirements and ethical considerations. 4. Conducting thorough risk assessments, including potential compliance and operational risks. And 5. Developing a phased implementation plan with robust testing and monitoring mechanisms to ensure successful integration and ongoing compliance. Question 3. The assessment process reveals that a significant number of new life insurance applications are being processed with minor data entry errors or incomplete fields, often due to time pressures on administrative staff. To expedite processing, a new departmental guideline is proposed that suggests administrative staff should make reasonable assumptions to fill in missing demographic details and correct minor typographical errors without recontacting the applicant. Which of the following approaches best adheres to the principles of accurate application completion and regulatory compliance? A. Implement a comprehensive training program for administrative and underwriting staff on the critical importance of accurate data capture. Establish clear protocols for verifying all application information, and mandate the recontacting of applicants for any missing or ambiguous data before policy issuance. B. Authorize administrative staff to use their best judgment to fill in any missing applicant information based on common demographic patterns, and to correct minor data entry mistakes to accelerate the application process. C. Develop a system where only the most critical fields are verified, and minor discrepancies or omissions are automatically accepted to improve processing efficiency. D. Rely solely on the applicant's initial submission, assuming all provided information is accurate and complete, and only address issues if they arise during the claims process. Option A. Develop a system where only the most critical fields are verified, and minor discrepancies or omissions are automatically accepted to improve processing efficiency. Option B. Implement a comprehensive training program for administrative and underwriting staff on the critical importance of accurate data capture. Establish clear protocols for verifying all application information, and mandate the recontacting of applicants for any missing or ambiguous data before policy issuance. Option C. Rely solely on the applicant's initial submission, assuming all provided information is accurate and complete, and only address issues if they arise during the claims process. Option D. Authorize administrative staff to use their best judgment to fill in any missing applicant information based on common demographic patterns, and to correct minor data entry mistakes to accelerate the application process. The correct answer is B. Implement a comprehensive training program for administrative and underwriting staff on the critical importance of accurate data capture. Establish clear protocols for verifying all application information, and mandate the recontacting of applicants for any missing or ambiguous data before policy issuance. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient processing with the absolute imperative of regulatory compliance and customer protection. Inaccurate application completion can lead to significant downstream issues, including policy rescission, claims disputes, regulatory penalties, and reputational damage. The core of the challenge lies in ensuring that the application, the foundational document for the insurance contract, is a true and complete reflection of the information provided by the applicant, without introducing errors or omissions that could later be contested. The correct approach involves a multifaceted verification process that prioritizes accuracy and completeness at every stage. This includes thorough training for underwriting and administrative staff on the specific questions asked in the application, the importance of each piece of information, and the potential consequences of errors. It also necessitates implementing robust quality control checks, such as peer review of completed applications or automated data validation against established rules. Furthermore, clear communication channels with applicants to clarify ambiguous information or request missing details are crucial. This approach is ethically sound and aligns with regulatory expectations that insurers act in good faith and with due diligence. Specifically, under the framework governing insurance administration, insurers have a responsibility to ensure that policy contracts are based on accurate information. This duty is implicit in the principles of utmost good faith and fair dealing, which underpin insurance regulation. Failure to ensure accuracy in the application process can be seen as a breach of this duty, potentially leading to regulatory scrutiny and sanctions. An incorrect approach that relies solely on the applicant's initial submission without any internal verification is professionally unacceptable. This fails to uphold the insurer's responsibility to ensure the integrity of the underwriting process. It can lead to policies being issued based on incomplete or inaccurate information, which is a direct contravention of the principle that insurance contracts are based on a full and frank disclosure of material facts. This can result in adverse selection and financial instability for the insurer, and ultimately, a failure to protect policyholders. Another incorrect approach that involves making assumptions to fill in missing information, even with the intention of speeding up processing, is also professionally unacceptable. This bypasses the requirement for explicit and accurate disclosure from the applicant. Making assumptions can introduce factual inaccuracies into the application, which can invalidate the policy or lead to disputes during the claims process. This directly violates the principle of accurate representation, as the insurer is essentially creating information rather than obtaining it from the applicant. This can expose the insurer to regulatory action for misrepresentation or failure to adhere to underwriting standards. A third incorrect approach that involves accepting an application with obvious omissions or inconsistencies without seeking clarification from the applicant is equally problematic. This demonstrates a lack of due diligence and a failure to adhere to the insurer's own underwriting standards and regulatory obligations. It suggests a prioritization of speed over accuracy, which can lead to the issuance of policies that do not accurately reflect the risk being underwritten. This can result in financial losses for the insurer and potential issues for policyholders if claims arise that are affected by the unaddressed omissions or inconsistencies. The professional decision-making process for similar situations should involve a systematic review of the application against established underwriting guidelines and regulatory requirements. This includes a critical assessment of the completeness and accuracy of all provided information. If any ambiguities, omissions, or inconsistencies are identified, the immediate step should be to seek clarification from the applicant. The goal is to ensure that the final application accurately reflects the applicant's circumstances and that the policy issued is appropriate for the disclosed risk. This methodical approach, prioritizing accuracy and compliance, safeguards both the insurer and the policyholder. Question 4. The assessment process reveals that a significant number of recent applicants for a life insurance policy exhibit a pattern of seeking coverage shortly after experiencing a major life event that could increase their mortality risk, such as a serious health diagnosis or a significant change in lifestyle. The underwriting team is concerned about potential adverse selection, where individuals with a higher-than-average risk are more likely to purchase insurance. Which of the following approaches best balances the insurer's need to mitigate adverse selection with the ethical and regulatory requirements of fair underwriting? Option A. Automatically decline coverage for any applicant who has received a serious health diagnosis within the past year, regardless of the specific diagnosis or its prognosis. Option B. Enhance the underwriting process by requiring more detailed medical questionnaires and potentially independent medical examinations for applicants exhibiting certain risk indicators, ensuring that premium adjustments are directly tied to objectively assessed risk factors. Option C. Increase the premium for all applicants by a flat percentage to account for the perceived increased risk of adverse selection across the entire applicant pool. Option D. Implement a waiting period for coverage for all applicants who have experienced a major life event within the past 6 months, during which time the insurer will gather additional medical information. The correct answer is D. Implement a waiting period for coverage for all applicants who have experienced a major life event within the past 6 months, during which time the insurer will gather additional medical information. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to manage risk and maintain financial solvency with the ethical obligation to treat all applicants fairly and avoid discriminatory practices. The core issue is identifying and mitigating adverse selection without unfairly penalizing individuals who may have legitimate, albeit higher, risks. The regulatory framework for insurance administration, as exemplified by LOMA 302, emphasizes principles of fairness, transparency, and sound underwriting practices. The correct approach involves implementing underwriting guidelines that are actuarially sound and consistently applied, focusing on objective risk factors rather than subjective judgments or broad generalizations. This approach aligns with regulatory expectations that underwriting decisions be based on demonstrable risk and that insurers avoid practices that could lead to unfair discrimination. By using a combination of medical questionnaires, lifestyle inquiries, and potentially medical examinations, the insurer can gather sufficient information to assess risk accurately. The key is that these tools are applied uniformly, and the resulting risk classifications are directly tied to the data collected and actuarial principles. This upholds the principle of equitable treatment and ensures that premiums reflect actual risk, thereby preventing the insurer from being disproportionately burdened by high-risk individuals. An incorrect approach would be to deny coverage outright based on a generalized suspicion of adverse selection, without a thorough, individualized assessment. This fails to adhere to the principle of fair underwriting and could be construed as discriminatory. Another incorrect approach would be to impose a significantly higher premium without a clear, data-driven justification that directly links the increased cost to specific, identifiable risk factors revealed during the underwriting process. This could lead to an uninsurable market for certain individuals and potentially violate regulations against excessive or unfairly discriminatory pricing. Finally, relying solely on anecdotal evidence or stereotypes about certain groups to infer higher risk is ethically and regulatorily unsound, as it bypasses objective risk assessment and promotes unfair bias. Professionals should approach such situations by first understanding the specific underwriting guidelines and the regulatory framework governing them. They must then ensure that the assessment process is objective, data-driven, and consistently applied. If concerns about adverse selection arise, the focus should be on refining underwriting criteria and data collection methods to better identify and quantify risk, rather than resorting to broad-stroke denials or punitive pricing without adequate justification. This involves a commitment to continuous review of underwriting practices to ensure they remain both effective in managing risk and compliant with ethical and regulatory standards. Question 5. Process analysis reveals that a policyholder has requested a policy loan. Which of the following approaches best aligns with the regulatory framework for processing such a request? Option A. Immediately disburse the requested loan amount after a brief verbal confirmation of the policyholder's name and policy number. Option B. Disburse the loan amount and then inform the policyholder of the available loan value and any associated fees or tax implications. Option C. Process the loan request only after the policyholder has submitted a written request via postal mail, regardless of the urgency or other communication methods available. Option D. Verify the policyholder's identity through a secure, multi-factor authentication process, confirm the available loan value, and provide the policyholder with clear disclosure of loan terms and implications before processing. The correct answer is A. Immediately disburse the requested loan amount after a brief verbal confirmation of the policyholder's name and policy number. Explanation. This scenario is professionally challenging because processing loan and withdrawal requests involves balancing the policyholder's immediate financial needs with the insurer's obligation to maintain policy integrity and adhere to regulatory requirements. Mismanagement can lead to policy lapse, financial loss for the policyholder, and regulatory penalties for the insurer. Careful judgment is required to ensure accuracy, compliance, and customer satisfaction. The correct approach involves verifying the policyholder's identity and authorization, confirming the available loan or cash surrender value, calculating any applicable fees or taxes, and processing the request according to established procedures and regulatory guidelines. This ensures that the policyholder receives the correct amount, that the policy remains in force if a loan is taken, or is properly terminated if a withdrawal is a full surrender, all while complying with disclosure and reporting requirements. This approach is ethically sound and legally compliant, safeguarding both the policyholder's interests and the insurer's operational integrity. An incorrect approach that involves immediately processing a request without proper identity verification poses a significant risk of fraud and unauthorized access to policy values, violating the insurer's duty of care and potentially leading to financial losses for the policyholder or the insurer. This failure directly contravenes principles of good governance and customer protection mandated by regulatory frameworks. Another incorrect approach, such as delaying processing due to internal inefficiencies without clear communication to the policyholder, can lead to frustration, potential policy lapse if the funds were needed for premium payments, and damage to the insurer's reputation. This demonstrates a lack of customer service and operational diligence, which can be viewed as a failure to act in the policyholder's best interest and can attract regulatory scrutiny for poor service standards. A further incorrect approach, like providing inaccurate information about the loan or withdrawal implications, e.g., tax consequences or impact on future benefits, misleads the policyholder and can result in detrimental financial decisions. This violates disclosure requirements and ethical obligations to provide clear and accurate information, potentially leading to regulatory sanctions and legal liabilities. Professionals should employ a decision-making framework that prioritizes policyholder verification, accurate calculation of values, adherence to all contractual and regulatory stipulations, and clear communication throughout the process. This involves a systematic review of each request against established procedures and relevant regulations, ensuring that all necessary documentation is obtained and that the policyholder is fully informed of the consequences of their request. Question 6. What factors determine the optimal balance between claims processing efficiency and adherence to legal and regulatory requirements in the context of insurance administration? Option A. The thoroughness of the claims investigation, verification of policy coverage, and compliance with statutory timelines for claim resolution. Option B. The volume of claims received, with a focus on reducing backlog even if it means bypassing certain verification steps. Option C. The speed at which claims adjusters can process payments, regardless of the completeness of the claim file. Option D. The cost-effectiveness of the claims department, prioritizing the lowest possible payout amounts for all claims. The correct answer is A. The thoroughness of the claims investigation, verification of policy coverage, and compliance with statutory timelines for claim resolution. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient claims processing with strict adherence to legal and regulatory requirements. The pressure to reduce processing times can tempt administrators to overlook crucial steps, potentially leading to regulatory violations, financial penalties, and damage to the insurer's reputation. Careful judgment is required to ensure that speed does not compromise compliance or fairness to the claimant. The correct approach involves a systematic review of all submitted documentation against policy terms and applicable regulations, ensuring that each claim is assessed fairly and accurately. This aligns with regulatory mandates that require insurers to process claims promptly and equitably. For instance, regulations often stipulate specific timeframes for acknowledging claims, requesting further information, and issuing payment or denial. Adhering to these timelines and ensuring thoroughness in investigation and decision-making demonstrates compliance with the duty of good faith and fair dealing, a cornerstone of insurance regulation. This approach minimizes the risk of regulatory sanctions, litigation, and reputational damage by upholding the insurer's legal obligations and ethical responsibilities to policyholders. An approach that prioritizes speed by expediting claims without a comprehensive review of policy terms and supporting documentation is incorrect. This could lead to the improper denial of valid claims or the payment of invalid claims, both of which can result in regulatory scrutiny, fines, and legal action for unfair claims settlement practices. Another incorrect approach is to delay claims processing by requesting excessive or irrelevant information, which can also be deemed an unfair claims practice and violate regulations requiring promptness. Furthermore, an approach that relies solely on automated processing without human oversight for complex claims risks overlooking nuances that could affect claim validity or payout, leading to potential regulatory noncompliance and customer dissatisfaction. Professionals should employ a decision-making framework that integrates regulatory compliance into every stage of the claims process. This involves understanding the specific legal and regulatory requirements applicable to the jurisdiction, establishing clear internal procedures that reflect these requirements, and providing ongoing training to claims staff. When faced with competing pressures, such as efficiency targets versus thoroughness, professionals must prioritize compliance and fairness, recognizing that short-term gains from cutting corners are outweighed by long-term risks. A robust internal audit and quality assurance process can help identify and rectify any deviations from compliant practices. Question 7. Examination of the data shows that a policyholder has been consistently overcharged for their premiums over the past 2 years due to an administrative error in the system. The overcharge amount, while not substantial for any single premium payment, has accumulated to a significant sum. The administrator has identified this error and is considering how to proceed with rectifying the situation for the policyholder. Option A. Wait for the policyholder to inquire about their premium statements or potential discrepancies before addressing the overcharge. Option B. Initiate a full refund of the accumulated overcharged premiums to the policyholder immediately and inform them of the error and the corrective action taken. Option C. Inform the policyholder of the overcharge and offer them a choice between a partial refund or a credit towards future premiums, allowing them to decide how the overcharge is resolved. Option D. Adjust the current premium to reflect the correct amount going forward and do not refund the past overcharges, considering them as a minor administrative cost. The correct answer is B. Initiate a full refund of the accumulated overcharged premiums to the policyholder immediately and inform them of the error and the corrective action taken. Explanation. This scenario presents a professional challenge because it requires balancing the company's financial interests with the policyholder's contractual rights and regulatory obligations. The administrator must navigate potential errors in premium calculation and determine the appropriate course of action for premium refunds or adjustments, all while adhering to strict regulatory frameworks and ethical principles. The core of the challenge lies in ensuring fairness and compliance when an error has been identified that benefits the company. The correct approach involves proactively identifying the error, calculating the exact amount of the overcharged premium, and initiating a refund to the policyholder without delay. This aligns with the regulatory requirement to ensure fair treatment of customers and to rectify billing errors promptly. Ethically, it demonstrates integrity and a commitment to upholding the terms of the insurance contract. The regulatory framework for insurance administration typically mandates that insurers act in good faith and provide accurate billing. Overcharging premiums, even if unintentional, constitutes a breach of this obligation and requires remediation. An incorrect approach would be to ignore the identified overcharge, hoping it goes unnoticed. This is ethically unsound as it constitutes unjust enrichment and a violation of the policyholder's trust. It also carries significant regulatory risk, as failure to rectify billing errors can lead to penalties, fines, and reputational damage. Another incorrect approach would be to offer a partial refund or credit towards future premiums without the policyholder's explicit consent and full understanding of the overcharged amount. This could be perceived as an attempt to minimize the company's financial liability while not fully compensating the policyholder for the error, potentially violating regulations that require full restitution for overcharges. Furthermore, delaying the refund or making it conditional on the policyholder discovering the error themselves is also an unacceptable approach, as it shifts the burden of correction onto the customer and demonstrates a lack of proactive compliance. Professionals should approach such situations by first thoroughly investigating the discrepancy to confirm the error and its extent. They should then consult the relevant policy terms and regulatory guidelines to determine the precise obligations regarding refunds and adjustments. Transparency with the policyholder, clearly explaining the error and the proposed resolution, is paramount. The decision-making process should prioritize compliance, fairness, and customer satisfaction, ensuring that any financial adjustments are accurate, timely, and fully communicated. Question 8. When evaluating the impact of key insurance industry trends on the policy lifecycle, which approach best balances technological advancements with demographic shifts to ensure effective and compliant administration? Option A. focusing exclusively on demographic shifts by developing new product lines tailored to specific age groups, while maintaining existing administrative systems and technological infrastructure to avoid disruption. Option B. Implementing new digital platforms for customer interaction and policy management, without a comprehensive review of their implications for data security, privacy regulations, and accessibility for all demographic segments. Option C. Prioritizing the adoption of the latest AI and automation technologies to streamline administrative processes and reduce operational costs, with minimal consideration for how these changes might affect different demographic groups or existing regulatory frameworks. Option D. Conducting a thorough analysis of emerging technologies and demographic trends to understand their potential impact on policyholder needs, operational efficiency, and regulatory compliance, and then developing integrated strategies to adapt products, services, and administrative processes accordingly. The correct answer is C. Prioritizing the adoption of the latest AI and automation technologies to streamline administrative processes and reduce operational costs, with minimal consideration for how these changes might affect different demographic groups or existing regulatory frameworks. Explanation: this scenario is professionally challenging because it requires an insurance administrator to balance the adoption of new technologies with the fundamental principles of customer service and regulatory compliance, all within the context of evolving demographic needs. The pressure to innovate and improve efficiency through technological advancements must not overshadow the duty to serve policyholders equitably and transparently. Careful judgment is required to ensure that technological integration enhances, rather than hinders, the policy lifecycle administration, and that demographic shifts are addressed with sensitivity and appropriate product development or service adjustments. The correct approach involves a comprehensive assessment of technological advancements and demographic shifts, prioritizing their impact on policyholder needs, operational efficiency, and regulatory adherence. This approach is right because it aligns with the core responsibilities of an insurance administrator to manage the policy lifecycle effectively and ethically. Specifically, it necessitates understanding how new technologies like AI-powered claims processing or digital policy management can improve service delivery and reduce errors, while also recognizing how changing demographics, e.g., an aging population or increased demand for digital services from younger generations, require adaptable product offerings and communication strategies. This proactive and holistic evaluation ensures that the company remains competitive, compliant with regulations such as those governing data privacy and fair treatment of customers, and responsive to the evolving needs of its policyholder base. An incorrect approach that focuses solely on the cost-saving potential of new technologies without considering their impact on customer experience or regulatory compliance fails to uphold the duty of care owed to policyholders. This could lead to regulatory breaches if, for instance, automated systems are not adequately tested for bias, or if they create barriers for certain customer segments. Another incorrect approach that prioritizes rapid adoption of trendy technologies without a clear strategy for integration or understanding of their long-term implications risks operational disruption and potential noncompliance with data security regulations. Furthermore, an approach that ignores demographic shifts, continuing to offer products and services designed for a past generation, risks market irrelevance and could be seen as failing to meet the needs of a significant portion of the potential customer base, potentially leading to accusations of unfair market practices. Professionals should employ a decision-making framework that begins with identifying the key drivers of change, technological and demographic. This should be followed by an analysis of the potential impacts of these drivers on all aspects of the policy lifecycle, from underwriting and sales to claims and customer service. Crucially, this analysis must be filtered through the lens of regulatory requirements and ethical considerations. The final step involves developing strategies that leverage opportunities presented by these trends while mitigating risks, ensuring that all decisions are in the best interest of the policyholder and the long-term sustainability of the business. Question 9. Operational review demonstrates that an insurance company's application form for a new life insurance policy requests the applicant's detailed medical history, including past illnesses, treatments, and family medical history, as well as their current employment status, and a list of all their current financial obligations. The company's underwriting department has indicated that this information is necessary to accurately assess the applicant's mortality risk and financial capacity to pay premiums. Which of the following approaches best aligns with regulatory requirements for application forms and required information in the context of the LOMA 302 exams jurisdiction? Option A. The application form should be revised to remove the request for detailed family medical history and a comprehensive list of all financial obligations, as these may not be directly and solely necessary for underwriting mortality risk and premium capacity, and could potentially lead to privacy concerns or discriminatory practices if not handled with extreme care and specific regulatory justification. Instead, focus on direct health information and income verification. Option B. The application form should be simplified to only ask for the applicant's name, date of birth, and desired coverage amount, as this is the minimum information required to initiate an application, and further details can be requested later if needed. Option C. The application form should be revised to include additional questions about the applicant's lifestyle choices, such as smoking habits and recreational activities, as this information is crucial for a comprehensive risk assessment and is commonly collected by insurers. Option D. The application form should be retained as is, as all requested information is potentially relevant to assessing the applicant's overall risk profile and financial stability, and the company has the discretion to collect any information it deems useful for underwriting. The correct answer is A. The application form should be revised to remove the request for detailed family medical history and a comprehensive list of all financial obligations, as these may not be directly and solely necessary for underwriting mortality risk and premium capacity, and could potentially lead to privacy concerns or discriminatory practices if not handled with extreme care and specific regulatory justification. Instead, focus on direct health information and income verification. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for comprehensive information to assess risk and underwrite a policy with the applicant's right to privacy and the regulatory imperative to collect only necessary information. Misinterpreting or misapplying regulatory requirements regarding application information can lead to significant compliance issues, including fines, reputational damage, and even policy rescission. Careful judgment is required to ensure all legally mandated disclosures are made, and that the information collected is directly relevant to the underwriting process, avoiding discriminatory practices or the collection of extraneous personal data. The correct approach involves a thorough understanding of the specific regulatory framework governing insurance applications within the designated jurisdiction. This means identifying precisely what information is permissible and required for underwriting purposes, and ensuring that the application form clearly articulates the purpose for collecting each piece of data. Adherence to these regulations is paramount to lawful operation and consumer protection. Specifically, it ensures that the insurer is not collecting information that could be used for discriminatory purposes, or that is not essential for assessing the risk associated with the applicant. This aligns with the principles of fair information practices and regulatory compliance, preventing potential legal challenges and maintaining consumer trust. An incorrect approach of collecting all information that might be relevant, without a clear regulatory basis or direct link to underwriting, fails to respect applicant privacy and may violate data protection laws. This can lead to accusations of overreach and unnecessary data collection. Another incorrect approach, that of collecting only the bare minimum information and omitting legally required disclosures or data points essential for accurate risk assessment, exposes the insurer to significant underwriting errors, potential adverse selection, and regulatory penalties for non-compliance. This can result in policies being issued with inadequate premiums or coverage, leading to financial losses for the insurer and potential disputes with policyholders. A third incorrect approach, which involves making assumptions about the applicant's circumstances and filling in information without explicit consent or verification, constitutes a serious breach of data integrity and regulatory requirements, potentially leading to fraudulent applications and severe legal repercussions. Professionals should employ a decision-making framework that prioritizes regulatory adherence and ethical conduct. This involves 1. consulting the specific regulatory guidelines and statutes applicable to insurance applications in the relevant jurisdiction. 2. Clearly defining the underwriting purpose for each data point requested on the application form. 3. Ensuring transparency with the applicant regarding the information being collected and its intended use. 4. Implementing robust internal controls to review application forms for completeness and compliance before policy issuance. 5. Regularly training staff on regulatory requirements and best practices for handling applicant information. Question 10. Strategic planning requires that an insurance administrator evaluate the methods used to communicate surrender charges and fees to policyholders. Which of the following approaches best aligns with regulatory expectations and ethical best practices for transparency in policy administration? Option A. Disclosing surrender charges and fees only in a separate technical addendum to the policy contract that is not prominently featured. Option B. Including a general statement in the policy contract that surrender charges and fees may apply, without specifying the schedule or calculation method. Option C. Offering to explain surrender charges verbally upon request, but not including specific details in written policy documents. Option D. Providing a detailed surrender charge schedule and fee breakdown in the policy contract and in annual statements, using clear and understandable language. The correct answer is D. Providing a detailed surrender charge schedule and fee breakdown in the policy contract and in annual statements, using clear and understandable language. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to recoup acquisition costs and administrative expenses with the policyholder's right to understand and access the value of their policy. Misrepresenting or obscuring surrender charge information can lead to regulatory scrutiny, customer dissatisfaction, and potential legal action. Careful judgment is required to ensure transparency and compliance. The correct approach involves clearly and accurately disclosing all surrender charges and fees to policyholders at the time of policy issuance and in subsequent policy statements. This includes detailing the surrender charge schedule, any applicable administrative fees, and how these charges impact the cash surrender value. This approach is ethically sound and aligns with regulatory expectations for fair treatment of customers and transparency in financial products. Specifically, under the regulatory framework governing insurance administration, as implied by the LOMA 302 context, which typically focuses on U.S. state-level insurance regulations. Insurers have a duty to provide clear and understandable information to policyholders. This duty is often codified in laws requiring policy illustrations and disclosures to be accurate and not misleading. Failing to provide this clarity violates principles of good faith and fair dealing, and can contravene specific disclosure requirements designed to protect consumers. An incorrect approach would be to provide only a general overview of surrender charges without specific details on the schedule or calculation. This failure to provide specific, actionable information leaves policyholders vulnerable to unexpected deductions and undermines their ability to make informed decisions about their policy. Ethically, this is a breach of transparency. From a regulatory standpoint, it could be deemed misleading advertising or a violation of disclosure requirements, as it does not provide the policyholder with the full picture of potential costs. Another incorrect approach would be to bury the surrender charge information in dense, technical policy language that is difficult for the average policyholder to comprehend. Technically disclosed, the information is effectively inaccessible. This approach violates the spirit, if not the letter, of regulations that mandate clear and understandable policy terms. The intent of disclosure laws is to ensure policyholders can actually understand the implications of their policy choices, not merely to check a box for disclosure. This lack of clarity can lead to policyholders surrendering their policies without fully understanding the financial consequences, which is detrimental to their financial well-being and can lead to regulatory action for unfair or deceptive practices. A third incorrect approach would be to proactively discourage policyholders from inquiring about surrender charges or to provide evasive answers when asked. This behavior is ethically reprehensible and directly contravenes the insurer's obligation to act in good faith. It suggests an intent to mislead or conceal information, which is a serious regulatory violation. Such actions erode trust and can lead to severe penalties, including fines and reputational damage. The professional decision-making process for similar situations should involve prioritizing transparency and policyholder education. Insurers should adopt a proactive stance in communicating policy terms, especially those involving potential financial implications like surrender charges. This includes using plain language, providing clear examples, and making information readily accessible through multiple channels. When in doubt, err on the side of providing more information rather than less, ensuring that all disclosures are accurate, complete, and easily understood by the policyholder. This approach not only ensures regulatory compliance, but also fosters long-term customer loyalty and trust. Question 11. Regulatory review indicates that an insurance administrator is tasked with reviewing the premium setting process for a new life insurance product. The administrator must ensure that the proposed premium rates accurately reflect the risk associated with each policyholder, while strictly adhering to all applicable regulations. The administrator has identified age, the applicant's self-reported health status, and the requested death benefit amount as key factors influencing premium calculations. The administrator needs to determine the most appropriate method for incorporating these factors into the premium rates, ensuring both actuarial soundness and regulatory compliance. Option A. Utilize age and coverage amount to set premium rates, but allow individual underwriters to make discretionary adjustments to health-related premiums based on their personal judgment. Option B. Implement premium rates that are actuarially justified based on age, health status, and coverage amount, ensuring these factors are applied consistently and without unfair discrimination as per regulatory guidelines. Option C. Set a flat premium rate for all policyholders regardless of age, health, or coverage amount to ensure maximum fairness and avoid any perception of discriminatory pricing. Option D. Adjust premium rates based on age and coverage amount, but exclude health status to avoid potential privacy concerns and simplify the underwriting process, even if it means less precise risk assessment. The correct answer is B. Implement premium rates that are actuarially justified based on age, health status, and coverage amount, ensuring these factors are applied consistently and without unfair discrimination as per regulatory guidelines. Explanation. This scenario presents a professional challenge because it requires an insurance administrator to balance the company's need to accurately price risk with the regulatory imperative to ensure fair and non-discriminatory premium setting. The administrator must understand how factors like age, health status, and coverage amount directly influence the likelihood and potential cost of claims, and therefore the premium, while simultaneously adhering to strict legal and ethical guidelines that prevent arbitrary or unfair discrimination. The core difficulty lies in applying these factors objectively and transparently, ensuring that the resulting premiums are both actuarially sound and compliant with consumer protection laws. The correct approach involves a thorough understanding and application of the specific regulatory framework governing premium setting for the relevant jurisdiction. This means ensuring that any factors used to adjust premium rates, such as age, health, and coverage amount, are demonstrably linked to increased risk and are applied consistently and without bias. The regulatory framework likely mandates that these factors be actuarially justified and that the resulting rates are not unfairly discriminatory. For instance, age is a well-established predictor of mortality and morbidity, and health status directly impacts the probability of incurring medical expenses or death. The coverage amount directly influences the potential payout in the event of claim. Therefore, adjusting premiums based on these factors, when done in accordance with established actuarial principles and regulatory guidelines, is not only permissible but essential for sound insurance practice. An incorrect approach would be to arbitrarily adjust premiums based on factors not directly related to risk, or to apply risk-related factors in a manner that results in unfair discrimination. For example, using age as a sole determinant without considering other health indicators, or adjusting premiums for coverage amount in a way that disproportionately burdens certain policyholder groups without actuarial justification, would be a regulatory failure. Similarly, failing to document the actuarial basis for premium adjustments, or not having clear, consistent guidelines for their application, would violate principles of transparency and fairness, potentially leading to accusations of discriminatory pricing. Such actions undermine consumer trust and expose the insurer to significant legal and financial penalties. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the specific regulatory requirements and guidelines for premium setting in the applicable jurisdiction. Second, identify and validate the actuarial basis for any proposed premium adjustments, ensuring a direct and justifiable link between the factor age, health, coverage amount, and the risk. Third, implement these adjustments consistently and transparently, with clear documentation and audit trails. Finally, regularly review and update pricing methodologies to ensure ongoing compliance and fairness, seeking legal and actuarial expertise when necessary to navigate complex regulatory landscapes. Question 12. Operational review demonstrates that the customer data analytics team requires access to policyholder information to identify trends and improve service offerings. However, the IT security team has raised concerns about the potential for unauthorized access and data breaches if access is not strictly controlled. The administration department is considering several approaches to address this situation, which approach best balances regulatory compliance, data security, and operational needs. Option A. Implement a system where only authorized personnel within the customer data analytics team are granted access to specific, anonymized datasets relevant to their analytical tasks, with all access logged and audited. Option B. Grant all employees in the administration department read-only access to the entire customer database to ensure everyone has the information they might need. Option C. Prohibit all access to customer data by the analytics team and rely solely on external market research for insights. Option D. Require employees to sign a confidentiality agreement and trust them to handle data responsibly without implementing specific technical access controls. The correct answer is A. Implement a system where only authorized personnel within the customer data analytics team are granted access to specific, anonymized datasets relevant to their analytical tasks, with all access logged and audited. Explanation. Scenario analysis. This scenario presents a common challenge in insurance administration, balancing the need for efficient data access with the imperative to protect sensitive customer information. Professional challenge lies in interpreting and applying data management and security regulations within the context of a specific operational process, ensuring compliance without unduly hindering legitimate business functions. Careful judgment is required to distinguish between necessary data sharing and unauthorized access or disclosure. Correct approach analysis. The correct approach involves implementing robust access controls and data anonymization techniques. This aligns with regulatory requirements that mandate the protection of personally identifiable information, PI, and sensitive customer data. By restricting access to only those employees with a legitimate business need, and by anonymizing data where possible for analytical purposes, the company upholds its duty of care to customers and complies with data privacy laws. This approach demonstrates a commitment to data security best practices, minimizing the risk of breaches and unauthorized disclosures. Incorrect approach is analysis, an approach that involves granting broad access to customer data to all administrative staff, regardless of their specific roles or responsibilities, is a significant regulatory and ethical failure. This practice dramatically increases the risk of data breaches, identity theft, and misuse of sensitive information, violating data protection principles, and potentially leading to severe penalties under relevant privacy legislation. Another incorrect approach, which is to disable all data sharing capabilities and prevent any analysis of customer data, is also professionally unacceptable. While it prioritizes security, it cripples essential business functions such as risk assessment, product development, and customer service improvement. This can lead to operational inefficiencies and a failure to meet customer needs, indirectly impacting the company's ability to serve its policyholders effectively and competitively. A third incorrect approach, which is to rely solely on employee self-regulation for data handling without implementing technical safeguards or clear policies, is a recipe for disaster. This approach abdicates the company's responsibility to establish and enforce data security measures, leaving sensitive data vulnerable to accidental or intentional mishandling. It fails to meet the due diligence expected of a regulated entity and exposes the company to significant legal and reputational risks. Professional reasoning. Professionals in insurance administration must adopt a proactive and risk-based approach to data management and security. This involves understanding the specific data protection regulations applicable to their jurisdiction, conducting regular risk assessments, and implementing layered security controls. Decision-making should be guided by the principle of least privilege, ensuring that access to data is granted only on a need-to-know basis. Furthermore, continuous training and awareness programs for employees are crucial to foster a culture of data security and compliance. When faced with operational challenges, professionals should seek solutions that achieve a balance between operational efficiency and robust data protection, always prioritizing the safeguarding of customer information. Question 13. Benchmark analysis indicates that an insurance company is experiencing an increase in policy lapses, particularly among long-term policyholders approaching retirement age. The administration team is tasked with developing and implementing lapse prevention strategies. Which of the following approaches best aligns with regulatory expectations and ethical best practices for insurance administration? Option A. Automatically converting policies of policyholders with a history of late payments to a less favorable, higher-cost extended term option without prior explicit consent or detailed explanation of the terms and financial impact. Option B. Reducing the frequency and scope of customer service interactions for policyholders identified as having a high lapse risk to minimize administrative costs associated with retention efforts. Option C. Proactively contacting policyholders exhibiting lapse indicators with personalized communications detailing available options, benefits, and the value of continued coverage, offering tailored solutions to address their changing needs. Option D. Sending standardized, urgent notices to all policyholders with overdue premiums, highlighting only the immediate loss of coverage and associated risks, without providing specific reinstatement instructions or alternative options. The correct answer is C. Proactively contacting policyholders exhibiting lapse indicators with personalized communications detailing available options, benefits, and the value of continued coverage, offering tailored solutions to address their changing needs. Explanation. This scenario is professionally challenging because it requires balancing the insurer's financial interests in maintaining policyholder retention with the ethical and regulatory obligations to provide accurate and non-misleading information to policyholders. The core tension lies in designing lapse prevention strategies that are effective without exploiting policyholder vulnerabilities or contravening regulatory mandates designed to protect consumers. Careful judgment is required to ensure that all communication and actions are transparent, fair, and compliant with the specific regulatory framework governing insurance administration. The correct approach involves proactively engaging policyholders who are exhibiting lapse indicators with personalized, informative outreach that clearly outlines available options and benefits, emphasizing the value of maintaining coverage. This strategy aligns with regulatory expectations that insurers act in the best interests of their policyholders and provide clear, understandable information. Ethically, it demonstrates a commitment to customer retention through value demonstration rather than pressure tactics. This approach respects the policyholder's right to make informed decisions about their coverage. An incorrect approach that involves sending generic, high-pressure, save your policy notices that emphasize only the negative consequences of lapsing, without detailing reinstatement options or alternative solutions, fails to meet regulatory standards for clear and fair communication. It can be construed as misleading by omitting crucial information and may exploit policyholder anxiety. Another incorrect approach, which involves automatically enrolling lapsing policyholders into expensive, short-term extended term options without explicit consent or clear explanation of the financial implications, violates principles of informed consent and fair dealing. This can lead to policyholders paying for coverage they do not fully understand or need, potentially at a higher cost than other available options. A third incorrect approach, which focuses solely on internal cost saving by reducing outreach efforts to policyholders showing lapse risk, neglects the insurer's duty of care and can lead to higher lapse rates, ultimately impacting the insurer's long-term financial health and reputation, and failing to meet the spirit of consumer protection regulations. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves first understanding the specific regulatory requirements for policyholder communication and lapse management. Then, evaluating potential strategies against these requirements and ethical principles, ensuring that all proposed actions are transparent, fair, and provide genuine value to the policyholder. A critical step is to consider the policyholder's perspective and potential vulnerabilities, ensuring that strategies are not exploitative. Finally, implementing robust internal controls and training to ensure that all staff adhere to these standards is paramount. Question 14. The audit findings indicate that the cloud-based policy administration system used by the insurer may not fully comply with data security and privacy regulations for policyholder information. Which of the following approaches best addresses these findings while ensuring regulatory adherence and protecting policyholder data? Option A. Prioritize the cost-effectiveness of the cloud solution and select a provider that offers the lowest pricing, even if their security protocols are less robust. Option B. Conduct a comprehensive review of the cloud service provider's security certifications and compliance reports, and assess the insurer's internal data governance policies for alignment with the cloud environment. Option C. Accept the cloud service provider's assurances regarding their security measures and assume their compliance is sufficient without further investigation. Option D. Apply standard IT security practices to the cloud environment without specific consideration for the unique risks and regulatory requirements of cloud-based policy administration systems. The correct answer is B. Conduct a comprehensive review of the cloud service provider's security certifications and compliance reports, and assess the insurer's internal data governance policies for alignment with the cloud environment. Explanation: the audit findings indicate a potential gap in the oversight of a cloud-based policy administration system, specifically concerning data security and compliance with regulatory requirements for policyholder information. This scenario is professionally challenging because it requires balancing the operational efficiencies and cost benefits of cloud technology with the paramount duty to protect sensitive policyholder data and adhere to stringent insurance regulations. The administrator must make a judgment call that safeguards the company and its clients, while also considering the implications for business continuity and regulatory standing. The correct approach involves a thorough review of the cloud service provider's security certifications and compliance reports, alongside an assessment of the insurer's internal data governance policies and their alignment with the cloud environment. This approach is right because it directly addresses the audit's concerns by verifying that the chosen cloud provider meets established security standards and that the insurer has implemented appropriate controls to manage data within that environment. Regulatory frameworks, such as those governing data privacy and financial services, mandate that insurers maintain robust security measures for policyholder data, regardless of where it is stored. Proactively ensuring the cloud provider's compliance and the insurer's internal controls are in place demonstrates due diligence and adherence to these obligations, preventing potential breaches and regulatory penalties. An incorrect approach would be to solely rely on the cloud service provider's assurances without independent verification. This fails to meet the insurer's responsibility to actively manage and secure policyholder data. Regulatory bodies expect insurers to conduct their own risk assessments and due diligence, not to passively accept third-party claims. Another incorrect approach would be to prioritize cost savings over security, potentially selecting a provider with weaker security protocols to reduce expenses. This directly contravenes the ethical and regulatory imperative to protect policyholder information, exposing the company to significant risks of data breaches, reputational damage, and substantial fines. A third incorrect approach would be to assume that standard IT security practices are sufficient for a cloud environment, without understanding the unique risks and compliance requirements associated with cloud-based systems. This demonstrates a lack of specialized knowledge and a failure to adapt security strategies to the specific technological context, leading to potential vulnerabilities. The professional reasoning process for similar situations should involve a risk-based approach. First, identify the specific regulatory requirements applicable to policyholder data and cloud computing. Second, assess the risks associated with using a cloud-based policy administration system, including data security, privacy, and operational resilience. Third, evaluate potential cloud service providers based on their security certifications, compliance history, and contractual terms, ensuring they align with the insurer's risk appetite and regulatory obligations. Fourth, establish clear internal governance policies and procedures for managing data in the cloud, including access controls, data encryption, and incident response plans. Finally, Conduct regular audits and reviews to ensure ongoing compliance and the effectiveness of security measures. Question 15. Research into the administration of insurance policies reveals that a company is considering a transition to predominantly electronic application submissions. What approach best balances regulatory compliance, customer accessibility, and operational efficiency in managing both paper and electronic application types? Option A. Develop a robust electronic application system that captures all required data fields and offers clear instruction, while maintaining a readily available and equally processed paper application option for all customers. Option B. Implement an electronic application system with minimal data validation, assuming customers will accurately input all information, and offer paper applications only upon specific customer request with a significant processing delay. Option C. Accept paper applications but store them as scanned images without a separate data entry process, relying solely on the electronic system for all data management. Option D. Mandate electronic applications for all new business, phasing out paper applications entirely to streamline processing and reduce administrative costs. The correct answer is A. Develop a robust electronic application system that captures all required data fields and offers clear instructions, while maintaining a readily available and equally processed paper application option for all customers. Explanation. This scenario presents a professional challenge because it requires an administrator to balance the efficiency gains of electronic applications with the regulatory and customer service imperatives of ensuring accessibility and data integrity, particularly when dealing with diverse customer needs and varying levels of technological proficiency. Careful judgment is required to implement a policy that is both compliant and customer-centric. The correct approach involves establishing clear procedures for both paper and electronic applications, ensuring that the electronic system is designed to capture all legally required information accurately and securely, and providing accessible alternatives for customers who cannot or prefer not to use the electronic system. This aligns with regulatory frameworks that mandate fair treatment of customers, data protection, and the ability for individuals to access essential services. Specifically, it upholds principles of non-discrimination by offering paper options and ensures compliance with data privacy laws by having robust security measures for electronic submissions. An incorrect approach would be to solely promote or mandate electronic applications without providing a viable paper alternative. This fails to address the needs of customers who may lack internet access, digital literacy, or have disabilities that hinder electronic form completion, potentially leading to discriminatory practices and non-compliance with accessibility regulations. Another incorrect approach would be to accept paper applications but not implement rigorous validation or data entry procedures for them, leading to potential data inaccuracies, delays, and increased risk of fraud, which contravenes regulatory requirements for accurate record-keeping and operational integrity. A third incorrect approach would be to have a poorly designed electronic application system that is prone to errors, lacks adequate security, or does not capture all necessary information, thereby failing to meet regulatory standards for data completeness, accuracy, and customer data protection. Professionals should employ a decision-making framework that prioritizes regulatory compliance, customer accessibility, and operational efficiency. This involves understanding the specific legal and regulatory requirements for application processing, assessing the technological capabilities and preferences of the customer base, and designing a hybrid approach that leverages technology while ensuring inclusivity and data integrity through well-defined processes for both paper and electronic submissions. Question 16. To address the challenge of a client inquiring about accessing funds from their annuity during the accumulation phase due to unexpected expenses, what is the most appropriate course of action for an insurance administrator? Option A. Inform the client that no funds can be accessed during the accumulation phase and that they must wait until the annuity matures. Option B. Provide a detailed explanation of the annuity contract surrender provisions, including any applicable charges and the potential tax implications of withdrawals, while advising the client to consult a financial advisor for personalized guidance. Option C. Recommend specific withdrawal amounts and strategies that would minimize immediate financial impact based on the administrator's understanding of the client's situation. Option D. Suggest that the client surrender the annuity immediately to access their funds, emphasizing the potential for reinvestment in a more liquid product? The correct answer is B. Provide a detailed explanation of the annuity contract's surrender provisions, including any applicable charges and the potential tax implications of withdrawals, while advising the client to consult a financial advisor for personalized guidance. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate financial needs with the long-term implications of their annuity contract and the insurer's regulatory obligations. The client, facing unexpected expenses, is seeking to access funds from their annuity accumulation phase, while the insurer has a duty to serve its clients. It also has a responsibility to ensure that clients understand the consequences of their actions, particularly concerning tax implications and potential surrender charges, and to operate within the established terms of the contract and relevant regulations. The core of the challenge lies in providing accurate, unbiased information and guidance without offering financial advice, which is outside the scope of an administrator's role and could lead to regulatory issues. The correct approach involves clearly explaining the terms of the annuity contract, including any surrender charges or penalties that may apply to early withdrawals during the accumulation phase, and outlining the potential tax consequences of such withdrawals. This approach is right because it directly addresses the client's inquiry by providing factual information derived from the contract and general tax principles, without making recommendations. This aligns with regulatory expectations that insurers provide clear, accurate, and transparent information to policyholders. It upholds ethical principles by empowering the client to make an informed decision based on the realities of their contract and tax law, while respecting the boundaries of the administrator's role. An incorrect approach would be to suggest specific withdrawal amounts or strategies, or to downplay the potential financial impact of early withdrawal. This is ethically and regulatorily flawed because it constitutes providing financial advice, which an insurance administrator is typically not licensed or qualified to do. Such advice could lead to adverse financial outcomes for the client, potentially exposing the insurer to liability and regulatory sanctions for operating outside its authorized scope. Another incorrect approach would be to simply refuse to discuss any withdrawal options, citing confidentiality or policy limitations, without providing any relevant contractual information. This fails to meet the ethical obligation to assist clients within the scope of their inquiry, and can lead to client dissatisfaction and potential complaints, as it does not offer any helpful guidance regarding the contract's provisions. Finally, an incorrect approach would be to encourage the client to surrender the annuity without fully explaining all associated costs and tax implications, prioritizing the insurer's potential gain from new business over the client's best interest. This is a clear ethical breach and could violate regulations designed to protect consumers from predatory sales practices. Professionals should approach such situations by first understanding the client's request and then consulting the specific annuity contract and relevant regulatory guidelines. The decision-making process should prioritize transparency, accuracy, and adherence to the defined scope of the administrator's role. This involves providing factual information about the contract's terms, surrender provisions, and general tax implications, while clearly stating that the administrator cannot provide financial advice or recommendations. If the client's needs extend beyond factual information, they should be advised to consult with a qualified financial advisor or tax professional. Question 17. Analysis of the administrative processes for a life insurance company reveals a potential discrepancy in the collection and remittance of premium taxes across multiple states. The company has historically applied a single, generalized approach to premium tax calculation based on its primary state of domicile, without consistently verifying the specific tax laws and status requirements of each state where policies are in force. Which of the following represents the most appropriate best practice for addressing this situation to ensure regulatory compliance throughout the policy lifecycle? Option A. Rely on the company's external auditors to identify and rectify any premium tax discrepancies during their annual financial statement audit. Option B. Continue the current practice of applying the domicile state's premium tax rate to all policies, assuming this is acceptable as the company is licensed in its domicile state. Option C. Implement a comprehensive review of all policyholder locations and policy types to determine the correct premium tax liability for each state, ensuring accurate and timely remittance according to each jurisdiction's specific statutes and regulations. Option D. Initiate a review of premium tax obligations only when an audit is formally requested by a state's Department of Insurance. The correct answer is C. Implement a comprehensive review of all policyholder locations and policy types to determine the correct premium tax liability for each state, ensuring accurate and timely remittance according to each jurisdiction's specific statutes and regulations. Explanation: this scenario is professionally challenging because accurately determining and remitting premium tax involves navigating complex state-specific regulations that can vary significantly. Misinterpretation or oversight can lead to substantial financial penalties, interest, and reputational damage for the insurance company. A thorough understanding of the policy lifecycle, from issuance to claims, is crucial as premium tax obligations can arise at various stages and depend on factors like the insured's location, the type of insurance product, and specific exemptions. The correct approach involves a proactive and systematic review of all policy transactions against the premium tax laws of each relevant jurisdiction where the insurer is licensed to operate. This includes identifying the taxable situs of the risk, understanding any applicable exemptions e.g. for certain types of policies or entities, and ensuring timely and accurate remittance. This approach is justified by the regulatory requirement to comply with all applicable state insurance laws and tax statutes. Failure to do so constitutes a violation of these laws, potentially leading to audits, fines, and revocation of the insurer's license. An incorrect approach would be to assume a uniform tax rate across all states or to rely solely on historical practices without verifying current regulations. This is a failure because it ignores the fundamental principle of state-specific insurance regulation and taxation. Another incorrect approach is to only address premium tax when a specific audit or inquiry is initiated. This reactive stance is a failure because it demonstrates a lack of due diligence and compliance, exposing the company to penalties for past noncompliance. Finally, delegating premium tax responsibility to a third party without establishing robust oversight and verification mechanisms is also an incorrect approach. This is a failure because the ultimate responsibility for compliance rests with the insurer, and inadequate oversight can lead to errors being overlooked, resulting in non-compliance. Professionals should employ a decision-making framework that prioritizes understanding the specific regulatory landscape of each jurisdiction. This involves continuous monitoring of legislative and regulatory changes, implementing internal controls to ensure accurate data capture and reporting, and seeking expert advice when necessary. A commitment to ongoing education and compliance audits is essential to mitigate risks associated with premium tax obligations. Question 18. The investigation demonstrates that an underwriter is reviewing an application for a life insurance policy where the applicant has provided a recent medical report that appears to indicate a minor, well-managed chronic condition. The underwriting manual specifies detailed criteria for assessing such conditions, including required documentation and specific risk factors to consider for approval, decline, or special rating. The underwriter feels the condition is minor and the applicant seems healthy, but has not yet cross-referenced every detail of the medical report against the precise requirements in the manual for this specific condition. Which of the following approaches best reflects the required professional and regulatory standards for this situation? Option A. Expedite the approval process by approving the policy immediately and then request any missing documentation from the applicant for a post-issuance review. Option B. Thoroughly review the applicant's medical report against each specific criterion outlined in the underwriting manual for the identified chronic condition, ensuring all documentation requirements are met before making a decision. Option C. Proceed with approving the policy based on the underwriter's general assessment of the applicant's health and the perceived minor nature of the condition, as the manual's criteria are often guidelines rather than strict rules. Option D. Approve the policy and make a note to have a senior underwriter review it after issuance to confirm the decision, as the applicant is a valued prospective client. The correct answer is C. Proceed with approving the policy based on the underwriter's general assessment of the applicant's health and the perceived minor nature of the condition, as the manual's criteria are often guidelines rather than strict rules. Explanation: the investigation demonstrates a common challenge in insurance administration, ensuring consistent and compliant application of underwriting guidelines. This scenario is professionally challenging because it requires balancing the need for efficient policy issuance with the imperative to adhere strictly to established underwriting rules and regulatory mandates. The underwriter's judgment is critical, as deviations can lead to adverse selection, financial losses for the insurer, and potential regulatory sanctions. The core of the challenge lies in interpreting and applying complex guidelines in real-world situations, where individual cases may present unique circumstances. The correct approach involves meticulously reviewing the applicant's information against the specific criteria outlined in the underwriting manual. This includes verifying all required documentation, assessing risk factors as defined by the insurer, and making a decision that aligns precisely with the established guidelines. This approach is correct because it directly upholds the insurer's risk management strategy and ensures compliance with regulatory requirements designed to protect both the insurer and policyholders. Adherence to the underwriting manual is a fundamental ethical and legal obligation, preventing discriminatory practices and ensuring that policies are issued at appropriate premium rates based on assessed risk. An incorrect approach that involves approving the policy based on a general sense of the applicant's good health, without a thorough review of the specific medical information against the manual's criteria, fails to adhere to the established underwriting process. This introduces a significant risk of adverse selection, where individuals with higher than average risk are more likely to seek insurance, potentially leading to higher claims than anticipated. Ethically, it undermines the principle of fairness and equity among policyholders. Another incorrect approach, which is to bypass certain documentation requirements because the applicant is a long-standing client, is also professionally unacceptable. This creates an inconsistent application of underwriting standards, potentially exposing the insurer to unassessed risks. It also sets a dangerous precedent, suggesting that established procedures can be circumvented for certain individuals, which can lead to regulatory scrutiny and a breakdown of internal controls. A further incorrect approach, which is to approve the policy and flag it for a post-issuance review by a senior underwriter, is problematic because it defers the critical risk assessment to a later stage. While post-issuance reviews can be a valuable tool for quality control, they should not be used to bypass the initial underwriting process. The primary underwriting decision must be made at the point of application based on the available information and the underwriting guidelines. Delaying this assessment can result in a policy being issued that should have been declined or rated differently, leading to potential financial and regulatory issues. Professionals should approach such situations by prioritizing a systematic and documented review process. This involves understanding the underwriting manual thoroughly, meticulously comparing applicant data against its provisions, and making decisions that are clearly justifiable by the manual's contents. When in doubt, seeking clarification from senior underwriters or the underwriting department is a crucial step in ensuring compliance and sound decision-making. The professional reasoning process should always begin with the established guidelines as the primary reference point, ensuring that any decision is defensible and aligned with the insurer's risk appetite and regulatory obligations. Question 19. During the evaluation of a policyholder's request to change the beneficiary designation on a life insurance policy, which of the following administrative actions best aligns with the legal and regulatory requirements for policy changes within the United States insurance framework? Option A. Immediately processing the change based on the policyholder's verbal instruction over the phone, assuming the identity verification process was completed earlier in the call. Option B. Requiring the policyholder to submit a written, signed beneficiary designation form, verifying the signature against a valid government-issued identification, and updating the policy record only after confirmation of all requirements. Option C. Informing the policyholder that beneficiary changes are not permitted after the policy has been issued and advising them to open a new policy with the desired beneficiary. Option D. Implementing the beneficiary change based on the verbal request and sending a confirmation letter to the policyholder's last known address, without requiring a signed form. Correct answer is A. Immediately processing the change based on the policyholder's verbal instruction over the phone, assuming the identity verification process was completed earlier in the call. Explanation. This scenario is professionally challenging because it requires navigating the intersection of administrative efficiency and strict adherence to legal and regulatory mandates governing policy changes. The administrator must balance the policyholder's request with the insurer's obligation to comply with all applicable laws, which often dictate specific procedures for endorsements, amendments, or cancellations to ensure fairness, transparency, and the integrity of the insurance contract. Failure to follow these mandates can lead to regulatory penalties, legal disputes, and damage to the insurer's reputation. The correct approach involves meticulously reviewing the policyholder's request against the specific requirements of the relevant jurisdiction's insurance laws and the insurer's own established procedures for policy modifications. This includes verifying the policyholder's identity, ensuring the requested change is permissible under the policy terms and applicable regulations, obtaining necessary documentation, such as a signed amendment form, and accurately reflecting the change in the policy records. This approach is correct because it prioritizes compliance with legal and regulatory frameworks, which are designed to protect policyholders and maintain market stability. Specifically, it ensures that any alteration to the insurance contract is legally sound, properly documented, and communicated effectively, thereby upholding the insurer's duty of care and regulatory obligations. An incorrect approach would be to immediately process the change based solely on the policyholder's verbal request, without any verification or documentation. This fails to meet the regulatory requirement for proper authorization and documentation of policy changes, potentially leading to unauthorized alterations and disputes. Another incorrect approach would be to deny the request outright, without a thorough review of the policy terms and applicable regulations. This could be a regulatory failure if the requested change is permissible, and the denial is based on an arbitrary or misinformed decision, potentially leading to a breach of contract or unfair treatment of the policyholder. A third incorrect approach would be to implement the change, but fail to update all relevant internal systems and notify all necessary parties. This administrative oversight can lead to discrepancies in policy records, incorrect premium calculations, and improper claims handling, all of which have regulatory implications. Professionals should employ a systematic decision-making process that begins with understanding the policyholder's request, followed by a comprehensive review of the policy contract and relevant jurisdictional laws and regulations. This should then lead to the application of the insurer's internal procedures for handling such requests. If there is any ambiguity or uncertainty, seeking guidance from legal or compliance departments is crucial before proceeding. This structured approach ensures that all legal, regulatory, and contractual obligations are met, safeguarding both the policyholder and the insurer. Question 20. The control framework reveals that a significant number of recently issued life insurance policies have been incorrectly priced due to a data entry error during the application stage, which has subsequently impacted the initial premium statements. This error was not identified until policyholders began inquiring about discrepancies in their first premium payments. Which of the following actions best addresses this interdependency breakdown across the policy lifecycle? Option A. Advise policyholders to contact the customer service department to discuss their individual premium statements and resolve any perceived discrepancies on a case-by-case basis. Option B. Inform all affected policyholders of the premium error and offer them the option to pay the corrected premium or receive a refund for the overpaid amount, without investigating the systemic cause of the data entry error. Option C. Immediately recalculate and adjust the premiums on all affected policies and issue corrected premium statements, while simultaneously initiating a review of the data entry procedures and implementing enhanced validation checks to prevent future occurrences. Option D. Escalate the issue directly to the underwriting department for them to investigate the pricing discrepancies and determine the appropriate course of action for all affected policies. The correct answer is C. Immediately recalculate and adjust the premiums on all affected policies and issue corrected premium statements, while simultaneously initiating a review of the data entry procedures and implementing enhanced validation checks to prevent future occurrences. Explanation. This scenario presents a professional challenge because it requires an administrator to identify and rectify a breakdown in the interdependencies between critical policy lifecycle stages. The challenge lies in recognizing that a seemingly isolated issue in policy issuance can have significant downstream impacts on claims processing and customer service, necessitating a holistic understanding of the policy lifecycle. Careful judgment is required to pinpoint the root cause and implement a solution that addresses not just the immediate problem, but also prevents recurrence. The correct approach involves a thorough review of the underwriting and policy issuance processes to identify the specific data discrepancies that led to the incorrect premium calculation. This approach is professionally sound because it directly addresses the source of the error, ensuring that future premium calculations for similar policies will be accurate. This aligns with regulatory requirements for accurate record keeping and fair treatment of policyholders, as incorrect premiums can lead to financial hardship or disputes. It also upholds ethical obligations to provide accurate policy information and service. An incorrect approach of simply adjusting the premium on the existing policy without investigating the root cause fails to address the systemic issue. This could lead to repeated errors and a lack of confidence in the administration system. It also risks violating regulations that mandate accurate policy documentation and may be seen as a superficial fix that does not uphold the principle of fair treatment. Another incorrect approach of informing the policyholder of the error and offering a refund without correcting the underlying system flaw is also professionally deficient. While transparent, it does not prevent future errors and places the burden of potential future inaccuracies on the policyholder. This approach neglects the administrative responsibility to maintain accurate and reliable systems, potentially leading to ongoing compliance issues. A further incorrect approach of escalating the issue to the underwriting department without attempting to identify the specific data input error is inefficient and bypasses the administrator's role in initial problem identification. While underwriting may ultimately be involved, the administrator should first attempt to diagnose the issue within their purview, demonstrating competence and a commitment to efficient problem solving. This delays resolution and may indicate a lack of understanding of the interdependencies within the policy lifecycle. Professionals should employ a decision-making framework that prioritizes root cause analysis. This involves 1. Clearly defining the observed problem. 2. Tracing the problem back through the relevant policy lifecycle stages to identify the point of failure. 3. Evaluating potential solutions based on their ability to correct the immediate issue and prevent future occurrences. And 4. Implementing the most effective solution while ensuring compliance with all regulatory and ethical standards.